Welcome to Night Markets Media. My name is Jacobus Brink, the Chief Investment Officer and Head of Investment Research South Africa at SFO. Each week I'll be giving you our perspective on what's happening in markets, as well as my point of view as a family office professional. So after a very turbulent week that included a barrage of economic data and earnings news, stocks actually managed to end the week higher. It was another busy week on the earnings front, and this seems to have been what boosted optimism at the end of the week. I think the highlight of the week probably was the Apple results that we saw on Thursday, and despite the fact that the results as such wasn't that optimistic, the fact that they were referred to one of the largest stock buybacks in history, worth about $110 billion, seemed to have put some impetus in the market to start to rally. Including that, early in the week, we saw Tesla that also jumped about 15% post its aggressive sell-off last week on the news that they will be implementing this fully self-driving technology in China. These were the two main highlights that sort of seemed to give some impetus to the market this week. Moving on to another hot topic, currently the conflict in the Middle East. So on Saturday, we saw a Hamas delegation arriving in Cairo with Egypt and Qatar being the mediators in the current negotiations around a ceasefire. Israel did not dispatch a delegation to the talks. They have continually emphasized that they would like to have a limited ceasefire as opposed to a permanent ceasefire. So, we get the feeling that, before these negotiations even actually started, they might seem to break down again. And that's exactly what we saw at the beginning of the week. Not a great development as far as the peace negotiations in the Middle East are concerned. And I do think this is going to put some pressure on oil. We did see it base a little bit after selling off quite severely last week. Moving on to the Americas, I suppose the biggest event of the week was the FOMC meeting. Widely expected that they were going to leave rates unchanged, which is exactly what they did. The focus, as normal, was more on the post-FOMC press conference with Chairman Jerome Powell. Painted a fairly rosy picture, despite the fact that we've seen some sticky and unexpectedly upwardly revised inflation numbers of late, and also referring to the fact that we have seen a little bit of a slowdown in growth. The latest GDP numbers we saw out of the US has been quite a bit lower than expected. The market expected it to come out in the region of 2.3%. The actual number was revised down to 1.6%, which is a fairly remarkable slowdown, despite the fact that we are still seeing positive growth. But I think the thing that was more pertinent in the post FOMC press conference was the fact that Jerome Powell actually started to allude to the possibility of stagflation. I think the way he portrayed it might make for an interesting meme going forward. He mentioned that he doesn't see the stag or the inflation. We'll have to see how that one turns out for him. I think delving into a little bit of the detail around, I think the one thing that has started to bug the market a little bit about where we are in the economic cycle point of view is the payrolls numbers that we saw on Friday. Now, this was obviously post the FOMC press conference. Payroll numbers have been the one thing that the FOMC has been hammering on, that, should they start to see the employment situation in the US soften, this could possibly lead them to actually start cutting rates earlier. And that's exactly what we saw on Friday, with the non-farm payrolls actually dropping to 175,000 jobs. This was the lowest amount since November. And this also gave the market some impetus to rally on the expectation that the Fed might actually start cutting rates earlier. I think one thing to keep in mind, though, is, we've come from a situation in November, December, where the market is actually pricing in 6 rates cut by year in 2024. That's now gone down to maybe 2, with probably the first rate cut we're only going to start to see in September. But if we see the job market cool off the way we have seen it now recently with the latest non-farm payroll numbers, this could definitely prompt the Fed to cut earlier. So after the initial sell-off earlier in the week and some of the softer job numbers we saw on Friday, markets rallied with the Dow Jones ending up 1.17% for the week. The Nasdaq also followed with 1.04% gain, and the S&P 500 lagged a little bit with a 0.6% gain. The cooling jobs numbers also helped the 10-year U.S. Treasury yield reach an intraday low of 4.45% on Friday afternoon, and this is the lowest level we've seen in about a month. Moving across the pond to the Eurozone and the UK, we saw first quarter GDP numbers out of the Eurozone come out quite strong, surprising to the upside, coming in at 0.3%, following that 0.1% decline we saw in the last quarter of 2023. This is a good news for the Eurozone in general. You know, we have seen them technically fall into a recession towards the back end of last year. So, you know, clearly a nice upward adjustment as far as economic growth is concerned. We also saw consumer prices come out fairly steady at 2.4%, you know, and this is definitely a big relief from the much higher numbers we saw towards the back end of last year. We also saw some of the ECB members come out, post these CPI numbers we saw, and they still feel fairly confident that they'll be able to start cutting rates in June of this year. So just looking at the market performance in the EU and the UK, markets ending broadly higher. Euro Stoxx 600 index was up 0.48%. And I suppose more specifically, the UK FTSE 100 index actually hit fresh all-time highs at up 0.9%. Okay, then over to the Asia-Pacific region. We got some good news out of Japan over the week. Nikkei 225 ending up 0.8%. Most of this was on the back of very strong earnings results that we've seen out of Japanese counters. About 2/3 of the publicly traded companies actually saw some very, very good improvements in earnings. Speaking of the yen, obviously very topical of late. We did see it sell off to a fresh 34-year low at around 160 yen to the US dollar. But it does seem like there has been some intervention from the Japanese central bank to prop up the currency. It actually ended the week quite a bit stronger at 152 yen to the dollar. Moving over to China, we saw some good news out of there for a change. Saw some good PMI numbers. It does seem that the manufacturing sector in China at least is stabilized for now, seeing some positive growth out there. I think the big thing that we're going to have to look for here is a tick up in consumer sentiment. The Chinese consumer still seems very depressed at this stage, and the continued drag we're seeing from the property sector in China once again came to the fore this week, as we saw a decline of 45% in the value of transactions in Chinese property. I think before we start to actually see a pickup in the property sector in China, we won't necessarily have very good news out of there, but at least, like I mentioned, this week we saw continued improvement in China on the manufacturing side, and there's definitely, further indications from the CCP that they will stimulate the economy from a monetary and a fiscal point of view. And then finally, bringing it back home to South Africa, we had some good news to cheer about. We saw some positive numbers out of the manufacturing sector. This is actually the first time since March 2022 that we saw the manufacturing sector growing, which is great. It just shows you what could happen if we don't have load shedding. We've obviously gone through about a 6-week period without any load shedding. But, I think the market is hesitant to get too optimistic about this because we are moving into the winter months, and, the election period is also ahead of us, so not the market not getting ahead of itself with excitement, but at least we saw some good news out of the local front. Because of that, the all-share index gained 1.4% for the week. All of the sectors ended up in the green, except the resources sector, which was dragged down a lot by the oil price and gold selling off a little bit on the positive moves we saw in the Middle East. And the Rand also had a fairly strong week, ending at 18.46 to the dollar. And then just ending off, looking at the week ahead, it's a fairly muted week as far as macroeconomic data is concerned. We are seeing interest rate decisions out of the UK and Australia, which would probably be the headline. As always, the jobless numbers in the US will be in focus, given that we've spoken about, some softness we're possibly starting to see in the US. We'll also get some consumer confidence numbers out on Friday, which could also just give us an indication of, what the consumer sentiment currently is in the US. And as always, I'd like to leave you with an interesting investment idea we discussed during the week. This week we chatted about Samsung. Price did pull back a little bit of late on the back of some weak earnings we saw. But, we do still think the company has got a great diversified business, lots of cash on hand, very strong balance sheet, and it's currently still trading at a 14 PE, which is a bit of a discount versus its peers. So we think it's something to consider. And fun fact, Samsung is currently still one of the largest family-owned enterprises globally. Financial markets close at 5 p.m. Night markets opens at 6. Let's start the conversation.